We've got Lakshmi Iyer, who's Head of Products and Fixed Income at Kotak Mutual Fund, joining us live on the show right from here in Mumbai. Lakshmi, to begin with, on the 10-year bond, where do you see yields headed in the near term?
The 10-year bond yield got I would say, sort of a positive surprise with the rate cut of 50 basis points, which was an unanticipated event. The 10-year saw a low of almost 8.25% on 17th of April. Subsequently, the market took more cognizance of the fact that RBI may not cut rates in the same manner as which it did it on 17th of April, and subsequently the yields went up to upwards of 835, 840. Currently, it's trading at about 8.45 levels, again in anticipation of further supplies. So our sense is that given this kind of a backdrop, and the fact that incremental rate cuts would happen in a gradual manner, 10-year range, at least for this quarter, would be broadly in the band of say 8.25 to maybe 8.5.
Right, but Lakshmi, there are colleagues in your industry who believe that the yield on the 10-year bond is never going to ever drop to 8, or and absolutely certainly not below 8%. In the whole of this financial year, given the fact that you have supplies coming into the market, and they believe that this is going to be the scenario even if you do see an additional rate cut maybe in October or next January. Is that a fair assessment?
See, before I answer that question directly, last year or just as recent as Jan, with the overnight rates at 8.5%, we actually saw 10-year hit a low of around 8.1%. And that clearly was on the back of A, high supplies. Supplies continue to be there. And B, most important thing is there was intervention by the Reserve Bank through open market operations. So my take on that is two things would be instrumental in pulling down rates to 8%. One is you see further rate cuts, or at least expectations of rate cuts, maybe not in the immediate couple of quarters, but subsequently after that. And more importantly, how much is RBI willing to come into the market in financial year 13 and support bond yields through open market operations. The probability of that is looking very difficult because the liquidity levels are far under control today than what it was about 3 months back. So liquidity, RBI has always stated that liquidity is the consideration for open market operations and not supporting yields. It is incidental that yields drop to those levels. So coming to your question, we see yields range bound in the band of 8.25 to 8.5. Either of the side being breached, in this case 8.25 being breached on the lower side, would be a function of open market operations, which is highly questionable, and of course rate cuts, which we don't see immediately. So I think at least for the next 3 to 6 months, we don't see 10-year going up to 8%. Probably second half, it could be an eventuality if you see rate cuts.
So, Lakshmi, you have said that, OMOs are going to be, aren't going to be easy to come in the months ahead, but there are some people in the fixed income markets who believe that who are actually placing a lot of hope on OMOs holding up the liquidity situation. How likely do you believe that is, given the fact that the MSF cushion has actually been enhanced for the banking system?
See, the RBI, OMOs is something which the RBI announces, it conducts it, it's more of a primary thing. RBI also does secondary market operations, buying of government and securities and selling of government securities. That is something they have been doing, and we're not saying that the possibilities of OMOs are completely ruled out, but if RBI is able to manage the secondary market purchases much more deftly, the necessity for open market operations may not be that relevant. And of course, as I said, or as you rightly pointed out, the enhancement of the MSF facility also is a case in point, saying that liquidity need not be as tight, or if it is, then you have this additional cushion to really come to us and borrow. So if you were to add the two together, the pace or the aggression with which OMOs happened last year may not really be required this year.
Lakshmi, we have already started seeing the central bank's intervention in the currency markets. Is that indicative of perhaps the liquidity situation tightening in the near term?
That definitely is a cause of concern, because any direct intervention to support the falling rupee would have negative repercussions on liquidity. But again, as I said, it did not happen immediately, because in the month of April, for example, we had about 35,000 crores of maturities. That money saw its way into the system. In the month of May, again, we have a similar amount in the first week of May itself. So even if there were to be an intervention is likely to be at gradual levels, because it's not that dollar rupee is falling off the cliff and it's like reaching a point of no return. So if at all the impact of this on liquidity would get aggravated, say around advance tax, but for now, as long as the liquidity, yes, it is around that 1 lakh crore kind of mark, as long as it is hovering in the band of say 70,000-80,000 crores, closer to 1 lakh crore, I don't think we need to really get overtly concerned about a possible currency intervention leading to tighter liquidity, at least in the next couple of months.
All right, the RBI has pegged a target of 6.5% on inflation from March 2013, from that timeline. Is there a sense that in between, in the months to come, that is, that target would weigh in on the kind of movement that we're seeing in inflation right now?
The target obviously has been given, because that's what, how the policy review works. One needs to see the components of inflation, which is largely oil and non-oil commodities. As far as non-oil commodities are concerned, we don't really see too much of a threat. Oil, obviously, near term has been very well under check in terms of its behavior. We've seen a momentum on the lower side. But as and when you find oil going out of control, we being heavily dependent on oil as part of our imports, it may obviously start playing a little bit on the inflation psyche, and therefore could really be beyond that. But as of now, I think, say, at least till June, July, thanks to the base effect, as also the momentum which is on the lower side, I think it looks to be that we would be within the range. Probably second half is where we need to take stock and revisit based on these parameters that I just mentioned as to what could be the incremental impact on inflation.
And also quickly, Lakshmi, what are you all working on at Kotak in terms of how much more the RBI could likely cut rates by before the end of this financial year?
See, the stance of the policy has clearly guided that we've done 50 basis points. The clear trigger seems to have been a sharp revision downward in the Jan IIP numbers, because as of March and April, any incremental data point, there has been nothing to suggest that it warrants a very aggressive rate cut. And of course, the last cautionary statement from the Reserve Bank that we would be extremely cautious of doing incremental rate cuts unless data warrants. I think that leads us to believe that if at all there were to be a rate cut, that would happen in the second half, and maybe another 25 basis points.
Right. Lakshmi, we'll have to leave it at that. Thanks very much for joining us and giving us your perspective on the fixed income markets here.